Stop whatever you're doing. I don't care if you're in the shower, stuck in a work meeting, or watching this on the toilet while your boss thinks you've got food poisoning. Drop everything. This is important. It's Wednesday, January 28th. And yesterday, while you were living your normal little life, something happened that should have ruined your weekend. $1.7 trillion vanished from the precious metals market in 90 minutes. 90 minutes is less than a Marvel movie. It's 2 episodes of whatever you're binging right now. And in that time, more money disappeared than the entire GDP of Spain. More than Mexico's GDP. Poof, gone. Silver was at $117.75. Its all-time high, a price it had never touched in the history of humanity. Never. Not when the Hunt brothers tried to corner the market in the 80s. Not when the world was falling apart in 2011. Never. And 90 minutes later, it was at 103. $14 down, 12% gone. Meanwhile, gold went from 5,100 to 5,000. A measly 2%. Same market, same moment, same apocalypse, and silver dropped 6 times more than gold. Interesting. And here's the question that brought you to this video. The question everyone's asking right now. Is the party over? Was it a bubble? Are we looking at the crash? Because if you own gold or silver, yesterday was rough. One of those days where you check your phone every 5 minutes and regret it every single time. And if you were waiting to buy, you went to bed last night thinking you're a genius for staying on the sidelines. Well, I've got news for you. No, this wasn't the crash. And today I'm going to prove it with data, not opinions. I'm going to show you what central banks are doing, the only ones who actually know what's coming. And spoiler alert, they've been doing the exact same thing for 15 years. Buying nonstop, at any price, including this one. By the way, my name's Carter, and I've been saying this stuff for over a decade. When gold was at 1,800 and the TV experts were calling it the top, Carter was buying. When silver was at 25 and everyone was laughing at those of us talking about $100, Carter was there. They called us crazy, bubble chasers, conspiracy nuts. And now? Now those same people are searching for videos on how to buy gold. Welcome. You're late, but welcome. Let's start with what happened yesterday. Because if you don't understand the mechanics of that drop, you're going to make the worst financial decision of your life. And Carter doesn't want that for you. At 9 a.m., New York time, silver hit 117.75. All-time high. Twitter was unbearable. Rocket emojis everywhere. People posting about early retirement, the kind of cringe euphoria that makes you embarrassed to be human. And 90 minutes later, silence. $103. The ones celebrating were now looking for someone to blame. Manipulation, they said. The banks robbed us. And you know what? They're right. But not in the way they think. But wait, before I explain the manipulation, you need to understand why silver dropped 12% while gold only dropped 2%. Because that's not a coincidence. I'm going to show you something that probably no TV analyst has ever shown you. There's a line on the silver chart that's been there since 1996. 30 years. A trend line that's marked the most important tops and bottoms of this market for 3 decades. In 2008, during the financial crisis, silver dropped and touched that line. At what price? $8. $8. And what happened next? Silver went from 8 to 45 in 2.5 years. 462%. That line acted as support. Picture a ball falling. It hits the floor, bounces back up, hard. Now fast forward with me to yesterday. Silver touched that same line, the exact same one, but this time it touched it from below. And here's the key. In technical analysis, when support breaks and price comes back to touch it from below, that support becomes resistance. The floor becomes a ceiling. And when a ball hits a ceiling at full speed, what happens? It bounces back down. That's exactly what happened. It wasn't irrational panic. It wasn't the end of the bull market. It was a technical rejection at a level that's been defining this market for 30 years. Silver did what it was supposed to do. Think about this. If in 2008 silver touched that line at $8 and then rallied 462%, what could happen now that it touched it at 117 and bounced? Let that sink in for a moment. And now comes the part that's going to piss you off. Because what happened yesterday wasn't just technical. It was mechanical, orchestrated. The same old trick. The CME, the outfit that controls the COMEX, where gold and silver futures trade, raised margin requirements by 47% last week, from $22,000 to $32,500 per contract. Let me break that down for you. When you trade futures, you don't need all the money up front. You put down a deposit and control a larger amount, like buying a house with a mortgage. You put down 20% and control 100. Now imagine the bank calls you on Tuesday and says, "Hey, starting tomorrow, the down payment isn't 20%, it's 30. If you don't have it, we're selling your house." That's exactly what happened. Thousands of traders suddenly needed $10,000 more per contract. Overnight, no warning. The ones who didn't have the cash had to sell. Not because they wanted to, because they were forced to. Forced liquidation cascade. And on top of that, lease rates, which is what it costs to borrow physical silver in the market, spiked more than 30 times their normal level during the peak stress moments. 30 times. That means physical silver was so scarce that even institutions were fighting over it, but the paper price was crashing. Funny, right? And here's the best part. This is the same old trick. The same one. In 1980, the Hunt brothers took silver from $6 to $50. What did COMEX do? They implemented Silver Rule 7. Restricted margins. Silver crashed from 50 to 10. The Hunts went bankrupt. In 2011, silver rallied from 8 to nearly 50. What did the CME do? They raised margins 5 times in 9 days. 5. Silver crashed from 50 to below 30. And now in 2026, silver rallies from 30 to 117. What does the CME do? Raises margins 47%. Same trick, different decade. It's like that friend who always beats you at poker because he's the one dealing the cards, and you keep sitting down expecting this time to be different. But wait. Here's what the pessimists don't understand. After 1980, silver entered a 20-year bear market. That was a real crash. But after 2011, it dropped from 50 to 15, and then what happened? Now it's at 111. The 2011 crash wasn't the end. It was a pause before more than doubling. So the real question is this 1980 or 2011, the end or a breather? The answer is in the data, not in emotions, not in headlines. In the data, let's look at where we are today. Wednesday, January 28th. Gold is at $5,111. Silver at $111. A year ago, gold was at $2,770. Silver at $31. Let's do the math together. Gold is up 85% in 12 months. Silver is up 258%. 258. Read that again. If you'd put 1,000 euros in silver a year ago, today you'd have 3,580. Meanwhile, your brother-in-law, the Bitcoin maximalist, is still explaining his investment thesis at Christmas dinner. So far in 2026, and we're not even a month in, gold is already up 17%. And listen to this because it's important. Silver has gained more in January 2026 than the S&P 500 gained in all of 2025. 1 month of metals has beaten an entire year of American stocks. Surprise. And it's not like the market did badly. The S&P was up 18% in 2025, but gold was up 65, and silver 150. 2 consecutive years where the yellow metal that supposedly does nothing has outperformed the almighty American market. But don't worry, I'm sure those NASDAQ ETFs are the future. Sure thing, champ. Now here's what you really want to know. Price targets. How high can this thing go? Goldman Sachs just raised their gold target to $5,400 by December after a 65% rally. Normally, when something goes up that much, analysts lower their targets expecting a correction. These guys raised it. And Jamie Dimon, the CEO of JP Morgan, publicly said gold could reach $10,000. When the most powerful banker in the world starts sounding like Carter, the lunatic on YouTube, something big is happening. Conservative scenario for this cycle. Gold at 7,500, silver at 150. Aggressive scenario, gold at 10,000, silver at 250. Think that's crazy? Silver in 1980 hit $49. If you adjust that price for inflation to today, that's between $194 and $200 an ounce. In other words, Inflation-adjusted silver still hasn't broken its high from 46 years ago. It still has room to run just to match that peak in real terms. But price targets are just opinions. What really matters is what the people moving the money are doing. And this brings us to the most important part of this video. The world's central banks have been buying gold for 15 consecutive years, since 2010. Not a single year in that period where they sold more than they bought. But the pace has changed dramatically. Before 2022, they were buying 17 tons a month. Now they're buying 60, more than triple. And they're not buying because it's cheap. They're buying at $5,000 an ounce, at all-time highs. Think about that. You and I hesitate when something's expensive. We get scared. Central banks, with the best analysts in the world and access to classified information, are buying more than ever, at record prices. 95% of central banks surveyed by the World Gold Council said they're going to keep increasing reserves, not maintain them, increase them. Why? Because they're getting out of the dollar. Simple as that. The dollar has lost 10% in a year, its worst performance since 2017. The DXY index is at 96. 4-month lows. There are analysts talking about it dropping to 75. The Sell America trade. Sell American bonds, American stocks, dollars, and buy real assets that no government can print. Gold ETFs have seen the biggest inflows since 2020. The wealthy are buying physical bars directly, private vaults. Goldman Sachs mentions it in their report. Those in the know are preparing. But wait, this gets more interesting. Because while central banks are buying, the Federal Reserve is on fire. And this is from the last 48 hours. The Fed meeting started yesterday. Today they announced their rate decision. Everyone expects them to hold. But that's not the news. The news is that the Fed chair is under criminal investigation. First time in 110 years of history. On January 11th, 2 weeks ago, Jerome Powell recorded a public video, the chairman of the Federal Reserve, recording a video like some YouTuber. Why? Because the Department of Justice sent him grand jury subpoenas. Powell said in the video that the subpoenas are pretexts to punish the Fed for not cutting rates as fast as Trump wants. He said that, publicly. The Fed chair accusing the government of political persecution. On video. Meanwhile, Trump is trying to remove Governor Lisa Cook. First time a president has tried to remove a Fed governor. And this week, Trump is naming a candidate to replace Powell in May. Someone softer, more controllable. See how it all fits together? Political attack on the Fed. Dollar collapsing. Central banks hoarding gold. And the price at all-time highs. These aren't separate stories. It's the same story. The Western monetary system cracking in real time. And now the physical market. Because this makes my blood boil. Do you know how many paper contracts for silver exist for every physical ounce in COMEX? 356. It's like an airline selling 356 tickets for the same seat. 355 people are left standing at the gate. Available inventory has dropped from 86 million ounces to 28, down 67%, draining fast. And while paper in New York trades at 114, physical silver in Shanghai sells for 122. $9 difference between paper and real metal. That's a fractured market. And yesterday, while the paper price was crashing, you know what happened to physical premiums. They went up. Dealers didn't drop prices, some raised them. Because the demand from people trying to buy the dip was insane. Paper says one thing, physical says another. Those of us holding physical metal are watching them fight to buy what we already own. China imposed export restrictions on January 1st. Less than a month ago, the country that produces 60% of the world's refined silver isn't letting it leave anymore. Meanwhile, the market has been in deficit for 5 consecutive years. 820 million ounces of accumulated deficit. No solution in sight because opening a new mine takes a decade. Industrial demand won't stop. Solar panels need 200 million ounces a year. Electric vehicles, semiconductors, AI data centers, everything uses silver. The U.S. classified it as a critical mineral for national security. There are rumors the government is secretly stockpiling between 250 and 500 million ounces. 10 years of military supply. It's not conspiracy. It's geopolitics. And now here's the juiciest part. What's happened this week on Wall Street? TD Bank, one of the biggest banks in North America, has suspended all physical silver sales. If you go to their precious metals portal right now, you see a gray screen. Temporarily unavailable. It's not a logistics issue. The trucks aren't running late. They don't have the metal. The vaults are empty. And you know why? Because these financial geniuses, instead of building inventory during the biggest rally in history, decided to bet against it. Short positions. When silver was at 40, they sold paper betting it would drop. Silver went to 50. What did they do? Doubled down. They're bankers. Bankers don't admit mistakes. Bankers double down. Silver went to 70. Doubled again. 90. Again. They got stopped out at 92.50. That means the system forced them to close by buying at the highs. Losses in the tens of millions of dollars. And the worst part isn't that they lost money. Banks lose money all the time and the Fed just prints more. The worst part is that while they were fighting the market, they weren't building inventory. They used their capital to shoot at a tsunami instead of getting on a boat. And now they have neither the metal nor the capital to buy it back. Portal down. Clients staring at numbers on a screen they can't convert into anything real. It's like that friend who shorted Bitcoin at 10,000 and kept doubling down until he lost his house. Except with a $3,000 suit, an MBA from Harvard, and an office on the 40th floor of a Toronto skyscraper. And it's not just TD Bank. At Goldman Sachs, the head of precious metals trading is gone. Just gone. Disappeared. In the middle of the biggest market boom in 50 years, the guy controlling the largest flow of metals orders in the entire Western world is suddenly not at his desk. The official story says he left to pursue other opportunities. Right. You leave the most lucrative position on the planet at the best moment in the market to pursue opportunities. Makes total sense. What probably happened is exactly the same as TD Bank. He bet against the rally, thought he was smarter than the market, that retail investors were sheep, that he had the algorithms and the data and the connections, and the market ran him over. When you lose hundreds of millions of the bank's money, they don't pat you on the back and give you a Christmas bonus. They give you a cardboard box and security escorts you to the door. This is what's happening behind the scenes. The banks that bet against the rally are getting slaughtered. Heads are rolling on Wall Street and nobody's telling you about it on the news. Okay, Carter, this is all great, but what I want to know is how do I recognize when the real top actually arrives? Because I don't want to be the idiot who stays until the end and loses everything. I hear you. And I'm going to share the 4 indicators I'm watching, the same ones that marked the tops in 1980 and 2011. If they worked twice, they'll probably work a third time. The first is the gold-silver ratio. It measures how many ounces of silver you need to buy 1 ounce of gold. At tops, this ratio drops to 40 or even 32. Why? Because in the final phases, silver always rises faster. Latecomers buy silver because it's cheaper. It's dropping now, good sign, but it hasn't reached the danger zone. The second is the dollar. In 1980, it fell 30% before the top. In 2011, 40%. Now, it's down 16. It's at 96. Still has room to fall. The third is that rates need to bottom. Gold never tops until the Fed finishes cutting. They're holding now, 2 more cuts expected. We're not there yet. And the fourth, the most important, is a crisis event. In 2011, it was European debt. Now the candidate is Japan. Debt at 200% of GDP. 80 billion in banking losses, and this is from this week. The New York Fed did a rate check on Friday. That's a call to banks asking what price they'd buy or sell currencies at. It's what they do right before intervening in the currency market. Markets interpreted it as a signal that the U.S. might coordinate with Japan on an intervention to support the yen. Think about what that means. The United States helping Japan defend its currency. That only happens when things are really serious. If Japan needs emergency liquidity, they sell their $1.2 trillion in American bonds. And that would be twice as big as the European crisis. Looking at all 4 indicators together, 3 to 7 years left in this cycle. Now, the opposite case, because Carter isn't the kind of guy who only tells you what you want to hear. The bearish argument says it went up too fast, that parabolic moves end badly, that central banks might slow down, that if there's peace in Ukraine, safe haven demand drops. All of that's true. And it was also true in 2011 and 2008. And look where silver is now. The bearish argument ignores that the silver deficit has no short-term solution. that China restricts exports, that industrial demand continues even with world peace, and that the U.S. has $38 trillion in debt that doesn't disappear because Putin and Zelensky shake hands. The difference between a pause and the end is that during pauses, the fundamentals stay intact. Right now, they're stronger than ever. What am I doing? This isn't financial advice. I'm just some guy on the internet. But I'll tell you what Carter's doing. I'm not selling. I'm not panicking over one red day. I look at the 4 indicators and none of them tell me it's over. Days like yesterday are for buying, not selling. What I'm not doing is using leverage, because you saw what happens when they raise margins overnight. Look at the facts. Central banks have been voting with their purchases for 15 years. Goldman raises targets after a 65% rally. China stockpiles and shuts the export valve. COMEX vaults are draining. TD Bank shut down their portal because they bet against it and lost. Goldman's metals chief vanished. The Fed is under political attack. And the dollar is falling to lows while everyone in the know buys gold at all-time highs. This isn't a correction. It's a regime change. A monetary reset in slow motion. And resets don't send you a letter in advance. You don't get an email saying, hey, the system's changing next week. Get ready. That's not how it works. Resets just happen, and whoever was positioned survives. Whoever wasn't watches from the outside as others protected what was theirs while he waited for confirmation that never came. Central banks already voted. Institutions already voted. The wealthy already voted. The only question left is when you're going to vote. You can wait for CNBC to confirm it when gold hits 8,000, or you can act now while you still have time. See you in the next video.